Hi folks, and welcome back to Meaningful Money. Okay, I'm still here at Cape Cornwall, slightly different aspect this time, just to keep things interesting. Difficult to find places out of the wind actually, because the reason this is called Cape Cornwall is there's only two capes in the UK, because this is a point where two oceans meet. So as you imagine, it's like a promontory sticking out into the sea, and it's windy all the time, particularly today. But never mind. Going to talk this time about pensions tax relief. Now, as a subject, I imagine that's not gripping you. But what if I called it free money from the government? Would that turn you on? Well, it should do, and you should take advantage of it, because it is exactly that, free money from the government. Now, that doesn't happen very often. Usually it's the other way around. They're taking money off you, eh? How does it work? Well, let's say I want to put, this month, £100 into my pension. I send a cheque, or a direct debit or whatever, for £80 to my pension company, which is usually a life assurance company like Scandia, or Standard Life, or Legal & General, or Aviva, somebody like that. I send a cheque for 80 quid to them, and then they receive that, and they then get on the phone, metaphorically speaking, to Her Majesty's Revenue and Customs, and they say, Mr. Matthew has paid £80 into his pension, can we have his tax relief please? And the Revenue then send an extra 20 quid to my pension company, making my total contribution 80 plus 20, £100. Simple as that. Now, if I was a higher rate taxpayer, which means I'm paying 40% income tax on the top part of my earnings, then I can get another 20% from the government. But I get that through my tax return, and what they effectively do is they reduce my tax bill by another 20 quid. So it's not a bad deal, really. So I can, if I'm a higher rate taxpayer, I can have 100 quid put into my pension, but it's only going to cost me 60. For a basic rate taxpayer, I can have 100 quid in my pension, it's only going to cost me 80. So it's free money from the government. It really is that simple. And that's how it works. It just comes from the revenue, the insurance companies administer it, free money. So let's suck it up. Let's get as much as we can from this government. Where else can you put money into something and get an immediate 20% increase in the value of it? It's not like anything else, and pensions have had a bad rep over the years, but this, if for no other reason, means they're a good idea. Now, a couple of things to say about it. Firstly, you only get tax relief on the money that you pay in. So if your employer is paying in as well, you don't get tax relief on that. They do, because the money they pay into your pension is a sort of trading cost to them, and so their tax is less because they're making slightly less profit. So they get tax relief in a sense, but you don't. The other thing that's worth knowing is that the maximum amount that you can get tax relief on is the higher of £3,600 or 100% of what are called your relevant UK earnings. Now, where's that 3,600 come from? Well, that was brought in 2001 with the advent of stakeholder pensions. The idea being is that whether you have an income or not, you can still get income tax relief on your pension up to a contribution of £3,600 a year. So I mean, that's a pretty good deal, really. So the idea is that I could pay money into a pension for my 10-year-old daughter. Now, she doesn't pay tax because she hasn't got an income, because they don't give her any. But she can still get this free money from the government, even though she's only 10 years old, up to 3,600 quid a year. So that's where that number comes from. So that's remember, the maximum you can get tax relief on is the higher of 3,600 or 100% of your relevant UK earnings. Well, I mean, you're thinking, what? How can you put 100% of your earnings into a pension? You know, what would you use to eat? But think about it. Let's say you had an inheritance, say, and your financial advisor suggested you maximise your pension allowance and get as much free money from the government as possible. You know, you could put up to 100% of your relevant UK earnings, that's a technical term, by the way, into a pension and get tax relief on it. Now, there is unfortunately another cap. It's called an annual allowance, and that's 255,000. So you can't put any more than 255 grand into your pension in any 1 year. I realise that's going to come as a bitter blow to many of you, but I'm afraid that's the way it is. And that's pretty much it. That's essentially how it works. Free money from the government, suck it up, and let's take advantage of it. So, pensions are not a bad idea. They are just one string to your bow, though, when it comes to achieving your financial aims. I said there was a couple of quid pro quos when talking about it being free money. Remember, pensions are tied up until age 55 currently. I can see that age going up over time as well as we live longer, but currently you can't get your pension until age 55 except in very special circumstances. And when you get there, your fund built up in your pension pot has to buy you an income. At least most of it does, and that income is taxed as if you were earning it in a job. So, you know, they give with one hand now, and they take away with another when you get to take your income in retirement. So that's how tax relief works. It's free money, let's take advantage. It's a good deal. Thanks for watching. Next time we're going to start talking about the different types of pensions, starting with the personal ones, personal pensions and stakeholder pensions. See you next time, and goodbye from Cape Cornwall.